Now we want to pivot over into what is happening in the U.S. How are things shaping up in comparison to other years? And one of the things that when you look at, and just as a reminder, here we're looking at road fuels or mobility fuels, gasoline, jet, distillate, residual. We're looking at ways to just get an idea of how active is the economy, how active are people right now. And here you can see that last week we had 14.68 million barrels a day of demand, which, as you can see, tracks on very much on the lower end because we should be much closer to at this point in time, of 15.5 on our way to about 16 million barrels a day. Now, this past week, which was obviously a big week with 4th of July, we were at 15.358. But remember, that's the daily. When you look at the average, and that's why we always look at that 4-week rolling average, we're still below that 15 million barrel a day mark, which is the bigger concern when you look at how things are shaping up, because a lot of that is being driven by distillate. You're not getting in those bigger moves. And then that gasoline, which is still well off of where we were in 17, 18. Now, on average, it surpassed 19, but just previously, but on an average basis, it's still well below. And that's the issue that we have, is that we're still seeing these pressure points, and that's why we think that we're going to be that, let's call it 600 to 800,000 barrels a day below that average. And even in 2021, on the average side, we didn't really start to close that gap till the end of August. And a lot of that was driven based on what we had in the distillate side as some of that started to ramp up. And we're just not going to get that to the same way, given that economic pressure that we've talked about. Distillate stocks had a drop of 1.04 million barrels. That's 20 million below the 5-year average. It's still 2.2 million above, about 2.2 million above year over year. So again, not a huge issue right now from the year over year. But when you look at the 20-year, again, we should be seeing builds. And that's the problem when you start breaking things down, because of where are we seasonally. Now, are there periods where we have a little bit of a lull? Yes. And that happened here. We had exports that were a bit weaker, but still above the 5-year average. But you had runs coming down. So as you have runs coming down, that hits in terms of total production. But it's not a demand thing. I mean, if demand were normal, this would be a much bigger problem, but obviously it's not. The problem that we're going to get into is as we go towards the end of the summer, if we haven't at least made some progress back towards that 29-year average, we're going to have more problems as we head into the winter months. Imports came down slightly, 7,000 barrels a day. Still, right in line with the 5-year. It's just going to be a matter of how much of this product from the Middle East comes across. And as it comes across, because remember, Kuwait was built to send European and U.S. grade diesel into the market. So we do have options. The question is going to be how much does it cost? And that's why we see some of this pricing remaining a bit stronger, which is going to then lead to more problems when you look at the inflation side and some of the pieces that weigh on underlying consumer purchases. Now, when we start looking at just crack spreads, here you can see that things are still hanging in at about 33. Just like, again, this is just looking at diesel front month crack. It's just simplified. This is mathematical. This is just giving you an idea of where we are versus history. And one of the things that we had believed, we thought we were going to go to 30 and then come back down to about 25. Given what has happened in the market with the lack of that medium heavy crude, the low end of the storage side, you're seeing that, with storage being so low, the cracks are hanging in a bit higher. Now, just because this is the spread doesn't mean this is what the actual refiner is going to make, especially if you start seeing, because this is, again, taking a lump number, but what are the crudes that you were using to create this? And as those crudes get more expensive, this may be what it looks like on a financial side, but what is actually being made at the refiner level is a bit lower. It's still profitable. There's still every reason that they have to make diesel and gasoline at this point. But that is going to become a bigger issue, which is why we were thinking on an OSP side that even though Saudi was going to keep our view was that they were going to keep the cuts going into August at 500,000. Instead, they kept it at 1 million in July, 1 million in August, was at least reduce the OSP, because then that would help or at least provide some of that margin to the refiner, their key clients. But instead, we did not get that. And that's going to be an interesting one to watch in general. So now when we look at Pad 1, because distillate fuel was the biggest issue in Pad 1 last year, not to say it isn't a big issue everywhere, given the fact that, but it's not all areas are created equal, because Pad 1 is 15.3 million barrels a day below the 5-year average, where Pad 2 is 1.8, Pad 3 is 1.7. So you're still fairly comfortable on a 5-year average basis, not Pad 1. And you get an idea of the issues, because even on a seasonal basis, you normally start to get those builds. We're not getting that. And Pad 1 is going to be a huge problem, because this is where we still have a lot of fuel oil. This is where we have a lot of heating oil. And if we stay at these levels, you can see that the pain that happened during that. And we had a very warm winter. If we have a cold winter, which can happen during El Niños, that is going to become an even bigger problem as we head into the fall and winter months. And again, just putting it into perspective, on a Pad 3 basis, things are fairly normal. Have there been better years? Yes, but there's been way, way worse years. And this is where they're going to try to balance, because there's no easy or cost-effective way to get this product into Pad 1 outside of the Colonial Pipeline. The Jones Act vessels make it expensive, so and the limitations on the vessels you can use makes it expensive. So this is where we see some of these underlying problems. When we look at demand for distillate here, you can see that it bounced along seasonal lines. One of the things that we've been saying is it's going to stay at the very low end of the cloud. We don't see that changing. And it all comes and really stems from the trucking side, where trucking continues to remain low. We're back below 2019 levels using FreightWaves data, sonar, a lot of these underlying problems that continue to arise. And again, it's just based on where we are, what is happening in the market. We don't see that pivoting anytime soon. Then when we look at the U.S. rail traffic, you can see that things remain strong for motor vehicles. Again, that's going to stay the case. Metal ores, non-metallics. The petroleum and petroleum products is going to be an important one to watch, because the U.S. needs product. The U.S. needs crude. So again, that's going to come down from Canada, because we don't have the new pipeline. We do have the old Keystone, not the extension, obviously. And then it's how you're going to get product up into the market. And that, again, comes back and forth to some of these underlying issues. Now, when you look at grain, forest products, grain is a huge issue just because of how weak the harvests are, how, what the issues are going to be on that front. And then the intermodal, has gotten better, but you can still see it's well below last year. And we don't see that changing. And then you look at total carloads, intermodal units, total traffic. That's when you start looking at some of this data points. Obviously, 2020 was worse, but when you look at it against 22, 21, we're very much on the lower end. And this is, there is diesel that goes into this, but this is also showing you what's happening on the industrial side, the manufacturing side, and we just don't have that level of demand coming back to, again, the economic backdrop or that kind of headwind in general. Now, when we look at what is coming into the U.S., obviously there's been a bit of a slowdown coming into the fourth. Not surprising. So a lot of that gets bumped out. And but when you look at average time at awaiting berth, 0 vessels within 40 nautical miles, 0 total vessels due, 8 coming up in terms of current inbound. So again, still very normal, but trending at the lower end, because if you remember, this is comparing us to last year, and last year was when things had a massive drop-off. And the reason why we had that drop-off in 22 was because of the different levels of lockdown. So there was a big lockdown in China, then they got rid of, then they lifted it. And then remember, we had that other big lockdown as we got into the end of the year. I think it was as we got into October, November. So again, that's where you have to kind of balance some of these key pieces. When we look at the temperature side, The Midwest remains fairly below normal, near normal, especially as you look at New England. But when you look at the South, things are toasty, and that is not going to change. So when you then kind of compare this to what is happening in natural gas, what is happening in propane, there's a little bit of love to come, just given where some of the heat is, what some of the cooling needs are. But again, that's going to be something closer to, not like we're going to explode through $3, but remain something closer to about 275. Then when you start looking at gasoline, so gasoline had a draw of 2.55 million barrels. That's 18.1 million below the 5-year, above on the year-over-year basis. So PAD 1 remains on the low end at 8 million below. PAD 2 about 5.7. PAD 3, PAD 4, PAD 5 fairly normal. It's really PAD 1, PAD 2 that is driving some of this disconnect. But one of the things that we were talking about is that we were going to start to get some builds, a little bit of counter-seasonal builds. But as we said previously on the last EIA show, we expected a drop, a bit of a drop, but then actually a sizable increase in storage. And this, realistically, we think it's going to look very similar to 2022. Now, we don't see that big drop-off that we had in 22, but it's really, running back up and then kind of going sideways. And then, obviously you have a little bit of that decline, along seasonal norms. But we think there's going to be some pretty sizable counter-seasonal builds. And the reason why is because, again, low demand, but sizable imports. So when you look at imports only came down 6,000 barrels. That's still 64,000 above the 5-year average. And a lot of that was driven by PAD 5. So PAD 5 is actually, it makes sense to import product, especially because gasoline prices are still high in the U.S. It's still, the U.S. is still the best place to be within the region when you look at just opportunity in terms of price. So PAD 1 is still going to be the favorite spot. We're at 760,000 barrels a day of imports. We expect that to get back to about 800, 850, and that's going to really kind of carry us all the way through. When you look at where we get some of these sizable numbers, we do expect between 750 and 850 coming into PAD 1, which is really going to drive us and keep us elevated. When you look at blending components, there was a draw of 1.92 million barrels a day. 1.92 million. That brings us at 13.5 million below the 5-year, right in line with the year-over-year. So again, we see that acting pretty similar to it in general. But again, both of them support that there was a nice draw. Again, it should happen. You pull some of that through ahead of the ramp in driving. The ramp in driving happens this past weekend, but then you have that slow bleed as people don't come home. They come home at different times. Where typically, if July 4th is on a Sunday, you get Monday off. If it's on a Saturday, you get Friday off, and you have that long weekend. It kind of falls somewhere, in a weird spot, which means that you just get a little bit of that bleed down when you look at the back end of how people drive home. And that's when you look at what has happened historically, or at least against 2022. And we think that blending components is going to follow something similar to what we've seen previously. When you look at Asia Pacific, when you look at Europe, North America, so North America had that drop, but again, that drop normally happens for 4th of July. Again, nothing crazy. This is completely normal from a seasonal standpoint, especially when you look at Europe starting to come down, and then Asia Pacific continuing to be slightly below average. Right in line with 2022, actually even slightly below. That little blip was you had in China. You had the Dragon Boat Festival. Other areas have something similar. Then you had the Eid holiday, which again also had a little bit of an increase, but still minimal. You're still below the 2019 average. When you look at North America, still below the 2019 average, and that's something that we think is going to remain very stable. And then according to Gas Buddy, the U.S. gasoline demand rose 4.3% from last week and was 4.5% above the 4-week average. Very normal, which comes in at 9.45, which is very much in line with what we saw. And if you go back and look at the North American data from TomTom, is what they saw. So that's why when you look at what EIA said, it's a matter of just kind of balancing out what some of those figures look like. And this is going to continue to be the problem. You're watching diesel and gasoline really start to sync up again, and gasoline still remaining at the higher end and actually averaging over $3.50. You could say, well, compared to inflation, this is still cheap. It doesn't. This is still a big number for people that have watched their real wages drop 26 months in a row, have been decimated by inflation, continue to see inflation take a bite out of their paycheck, out of the amount that they're spending, and that's not adjusting anytime soon. So then when we look at the gasoline numbers in general, we want to look at where the demand is. Here you can see you get that nice little bounce. We just took out the high that we had in April, which is, again, very normal. We should take out that high, but it's just a matter of where do we settle out, and we see us settling out between that 9.4 and 9.5, and really not at that 9.6, 9.7. So we will have that shave down. And then once you factor in diesel and the other reductions, and that's why it's like when people say, "Oh, you're too bearish," it's like I'm not saying that we're going to be at 8.7. Well, if you remember, when we were at 8.7, I said that every week or every 10 days, you increase about 100,000 barrels a day as you go from the end of June. The middle of June, and then you start to attack that on, because as other areas within the U.S. come off of, school ends to go on holiday. Every region is different, but this July 4th to August 15th is the core where everybody in the U.S. has off. Then in August 15th, you have people on the West Coast, in the South, parts of the Midwest start to go back to school. And then as you go further north, it bleeds further and further over. And then that's when you get towards that Labor Day. So again, it's just that this is where we live. It's not going to get back to where we were historically. It's going to be slightly below, and that is going to be something to weigh on underlying demand. Propylene had a build of 1.57 million barrels, 17.5 million over the 5-year, that's going back till 2015, setting new storage records. Again, if it wasn't for our very, very robust export market, we would continue to see this become an overhang, and that's why the issue is right now naphtha, LPG continues to trade at a discount. We're producing a lot of it, and then the question is, where's fuel oil? Fuel oil continues to be at a premium. Jet fuel, had a build of 260,000 barrels. That's just 0.1 below the 5-year, right in line with the year over year. On a demand level, you can see that we get that spike. The spike came a little bit later than what it has in the previous times, but again, it's just going to fade a bit further down, and then bounce around between that 1.5. I should say average between that 1.55, 1.65. The 12-week ahead increased 1.9% compared with the week starting June 27th. Not too much of an adjustment here. You can see things are starting to level off in terms of that normalcy. On a delayed basis, you can see that delays continue to be a problem. As somebody who got stuck in Montreal, I don't know what it is about that airport, but I never have luck going through it. And again, fool me once, shame on you. Fool me twice, shame on me. The second time, yes, that was on me. Passengers, you can see maintaining that elevated level. We still had, we'll get the drop that you can see, that happened in 21, 22. It'll happen in this point, but again, it's just a matter of timing. It will just fall along kind of those normal lines in terms of that underlying flow. And then when we look at open table, you can see that things got a little bit better for the 4th, as they should, and then things dropped off, and we're seeing just a fairly stable reduction of eating out by about, let's call it 3 to 5%, which is something that I think is starting to show the kind of the cracks in that consumer spending landscape. So that's what we have for you with the U.S. In rounding it up and summarizing it, we see demand being a bit weaker than what the market is expecting, and that's going to again just keep things a bit weaker. And that's why when we look at the global market and these massive expectations of these huge demands in gasoline and distillate, it's like, well, in the backdrop that we see on the industrial side, the manufacturing side, the consumer, the TomTom data, the gas buddy data, we just don't see this huge surge in gasoline demand, which again is why we see this bit reduction. But as we've been saying, it's not that we're seeing this huge write down. It's just we're going to stay lower, and everyone's expecting us to close this gap, and we're just saying no, the gap's going to stay, and that's okay. But that's where, again, we're going to see some of that pressure, and why we think some of these pricing metrics are going to be a bit tighter, and why we see that range really holding, which we'll talk a bit more about in the next segment.